Welcome to the Riskwiser Zone, the show where we dive into the world of stocks and finance to help you make informed decisions about your investments. We've got a fascinating story to kick off our show as we take a closer look at the investment strategies of one of the most successful investors in history, Warren Buffett. The CEO of Berkshire Hathaway has been making headlines lately with his cautious approach to the market, and we're going to explore what this might mean for you, the investor. According to recent reports, Berkshire Hathaway has sold more stocks than it's bought for the 12th straight quarter, with the company selling $12.5 billion in equities while buying just $6.4 billion worth of stock. This trend is notable, especially given the strong third-quarter operating results that saw the company's wholly owned operating businesses increase their after-tax operating profit by 34% to $13.5 billion. But what's really caught our attention is that Berkshire hasn't bought back its own stock in 5 consecutive quarters, despite the stock seeing a meaningful dip from its highs in August. This has left the company with a record $381.6 billion of cash on its balance sheet, and it's got many investors wondering what Buffett's next move will be. Now, some might see this as a sign that Buffett thinks the market is overvalued and that he's waiting for a pullback before making his next big investment. Others might argue that this cautious approach is simply a reflection of the current economic uncertainty. As we always say on the Riskwiser Zone, it's essential to consider multiple perspectives and do your own research before making any investment decisions. While Buffett's track record is undoubtedly impressive, it's crucial to remember that his investment strategies may not be suitable for every investor. So, what can you take away from Berkshire Hathaway's recent moves? Should you be following Buffett's lead and taking a more cautious approach to the market? Or should you be looking for opportunities to invest in stocks that align with your own financial goals and risk tolerance? We'll continue to explore these questions and more as we delve deeper into the world of stocks and finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're exploring the world of finance and risk management, and today we have a fascinating story that sheds light on a concerning trend in the Indian IPO market. It appears that several startups are showing profitability just before their initial public offerings, often through accounting adjustments or one-off gains. This phenomenon has raised eyebrows among analysts and investors who question the sustainability of these profits. On one hand, it's not unusual for companies to present their financials in a more favorable light before an IPO. However, when this is done through accounting adjustments that don't reflect the true state of the business, it can be misleading for investors. Some experts argue that this practice is becoming widespread and risky, as it creates an over-optimistic view among retail investors. On the other hand, it's essential to note that these accounting-driven profits are usually disclosed and technically within Indian standards. The issue lies in the fact that many retail investors rely on gray market premium and market frenzy rather than carefully reading financial statements. This lack of transparency and scrutiny can lead to investors making uninformed decisions. Veteran investor Sandeep Sabharwal has criticized this trend, calling it murky and lacking transparency. He questions the absurd IPO pricing and how it still gets lapped up by institutional investors. Other experts, like Nitin Jain and Vinit Bolinjkar, also express concerns about the quality of earnings and the need for investors to look beyond headline profits. So, what can investors do to navigate this complex landscape? It's crucial to focus on cash flows, core operations, and durable growth rather than just headline profits. Investors should be cautious of one-off items that might make a company look profitable temporarily and instead scrutinize the earnings quality and the company's true value proposition. As we continue to explore the world of finance and risk management, it's essential to remain vigilant and informed. Remember, a profit before an IPO doesn't automatically make a company investment worthy. It's up to investors to do their due diligence and look beyond the surface level. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a look at some of the latest developments in the world of cryptocurrency. We've got two interesting stories for you. One about Cathie Wood's unwavering confidence in Bitcoin, and another about a tragic tale of a crypto trader who lost everything. First off, Cathie Wood, CEO of ARK Invest, has reaffirmed her 1 million price target for Bitcoin, despite the current market volatility. She attributes this confidence to the growing presence of stablecoins, which have recently surpassed $300 billion in total market value. According to Wood, this surge in stablecoins signifies a pivotal moment for the digital asset market and will ultimately contribute to Bitcoin's long-term growth. On the other hand, we have a cautionary tale about a crypto trader who lost his family's trust and investment due to his reckless trading decisions. The trader, who wishes to remain anonymous, took a devastating step by using his parents' investments without their knowledge to try and recover his losses. Unfortunately, he ended up losing everything, leaving him with a broken relationship with his family and a deep sense of guilt. These two stories highlight the contrasting views on cryptocurrency, from unwavering optimism to devastating loss. While Cathie Wood's prediction may be seen as overly ambitious by some, it's essential to acknowledge that the crypto market is known for its volatility. As for the crypto trader's story, it serves as a reminder of the importance of discipline and responsible investing. In conclusion, the world of cryptocurrency is full of uncertainties, and it's crucial to approach it with caution. Whether you're a seasoned investor or just starting out, it's essential to do your research, set realistic expectations, and never invest more than you can afford to lose. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.